Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Ramsey, how are you this morning?
I'm good. Always happy to be here.
Good. Hey, looking forward to our Innovation Retirement event we've got cooking in New York on Monday. Can't wait for your panel.
Absolutely. Well, we're going to be one of the topics we'll be talking about today. Sort of dovetails nicely with what we'll be talking about on Monday. So this is great.
No, this is great. And Mark, wonderful to have you back.
Thanks, Paul. It's great to be back. It's been a while, and I'm glad to be back on the program.
Yeah, no, and you'll be introducing the panel as well in New York. So looking forward to it on what's the role of the advisors, right, going forward? How do we help them? How do we help clients get advice? So thanks for doing that. And we've got a great guest, returning guest, somebody we've known for a long time. Mark, do you want to do the intros?
Yeah, sure. And perfect timing in terms of the role of the advisor in the ever-changing world in terms of the marketplace. And, you know, it's great to have Josh on. I've known Josh for over 10 years. Josh, I think you started your business back in 2006. And you've always had an incredible passion for education and marketing. And you've done a phenomenal job in terms of your outreach through infomercials and advertisements. I think you've reached over 14 million households over the years. You know, primarily educating on the differences of, guarantees of income in retirement and not guarantees and the benefits of annuities. And now you're taking a different look at it in terms of the various indices and crediting strategies that are out there. And obviously the vol control strategies have come into play over the last several years, a big byproduct of low interest rates. And you see a concern in the marketplace in terms of understanding that. So I know you're working on a white paper around this, and you put together a really cool tool/app, if you will, that I think does a great job in terms of really breaking it down to the fundamentals and giving the basics behind it. So with that, why don't you tell us a bit about when this became a concern from your perspective in terms of the need for education and how you feel this approach is best suited in terms of reaching the not only agent but end consumer?
You know, Mark, it's never been better to be in this annuity environment that we've been in today. For almost 15 years, rates have been very low. And annuities provide protected growth, or they can provide income for life. And these insurance companies have gotten more and more innovative because interest rates have been so low for such a long time. And they've been trying to figure out how to get more return for the client or for the policyholder. And that's where they created these amazing risk controls. What's happened in this last year as interest rates spiked, short-term rates and longer-term rates, with the innovative products, it's just put a lot more juice for the clients' potential for them to make some money or generate more income with this innovation of the products out there today.
And have you seen a shift in terms of, utilization? I mean, I guess if you look back 3 or 4 years, there was a very high concentration in folks electing the volatility-controlled structures and the bespoke indices. And again, to your point, a big byproduct of the low-rate environment and the impact on option budgets. And now with option budgets, much higher than they were, participation rates caps on standardized indices higher. Now they're starting to look at, the full platform. And this is where I think it becomes important to really kind of understand, what par rates are relative to each other in these different types of indices, and how to really best explain that in terms of the participation that you're actually getting in that underlying credit behind the scenes.
Yeah, well, over a decade ago, it was pretty simple. You get a cap of 10%, or a monthly cap of 3%. And a lot of these companies, if they didn't have a cap, maybe you get a percentage of the S&P 500 on a monthly average or annual point to point or so on. Now that these rates have increased, what the insurance carrier does is they take the interest rate and they take that rate and they buy calls or they buy options on major indexes such as the S&P 500, NASDAQ, or the innovative indexes that you guys make. The rates have, and the risk controls, if it's a 1-year maturity date, the insurance company can get a certain amount of percentage, but if they go 2 years or 3 years out on a percentage, they can get more purchasing power or juice on the options, which allows the policyholder to get a lot more crediting rate. So I just share that with you because, for about 15 years, there's only so much water you can squeeze out of that rock, and it's really hard to get a client a rate that beats inflation. And so that's one of the that's where clients are looking at these more and more, because if you look at just last year, bonds were down close to 20%, S&P was down close to 20%, and inflation was almost double digits. So the investor is getting hit in 3 different ways, and that's why people are trying to beat inflation safely, and that's why these products have never been better.
So one of the things that's happened in the last, I'll call it at this point, it's almost 10 years since the first one of these came out, and just full disclosure, this was a business that I ran in my prior life at one of the investment banks. One of the things that's happened, though, is there's been a proliferation of lots of different choices. And so how should people think about choosing, even within a single platform, there may be multiple different types of indices that are offered. I mean, how can you help, how do you help your clients or the people that you advise to think about either allocating between those various indices or choosing one or the other?
Well, I think financial advisors and policyholders are trying to put their arms around how much is my contract going to make? How do I measure that? Well, what has to happen for them to get a good return? And obviously, the policyholder has options. They can put their money in the fixed bucket, yielding 4 to 5%, depending what company you choose. They can choose like an S&P 500 option that has no cap, and a lot of the competitive rates out there are 50 to 70% participation rates. But then they have those innovative risk controls, and there are several hundred risk controls out there today. And how do you know which ones are good terms, and how do you know which ones are not so good terms? Because I remember back in 2007 when I actually had some clients in these index annuities, but they had monthly caps at the time. And I had a fairly upset client. And because I kind of said, well, you get market index upside, but you don't have the downside. And I think that year they made 5 or 6% interest on their policy, but the market was up almost 20%. So there was a disconnect on what the client thought they were going to make and what the policy actually credited. And that became a pretty fast learning curve to say, well, how can I manage the client's expectations? Because this is supposed to compete with savings vehicles. It's not necessarily supposed to compete with investments. And so as these risk controls became more and more innovative, now you're seeing participation rates at 100%, 200%, 300% or higher. And what 300% of what? And so what we did with our CFA is we kind of broke down a kind of a chart to help financial professionals understand what is your equity exposure, what is your participation rate, and that is working for you today. And for those of you that can see the screen, I'll share it with you. But one of the indexes that these are shared with is geared towards the VIX. The VIX is known as the volatility is a volatility control index. It's also known as the fear index. And you probably see this on CNBC, or you've heard about this in the past. But essentially, the VIX is determines what the cost of an option is on the S&P 500 or U.S. markets. The average VIX historically has been close to 16.5. And it changes. It changes depending if fear is high, if the VIX can spike. If fear is low, the VIX can drop. And you can see a little bit of the history of the VIX, but back in 2018, the VIX was as low as 12. Just a few days ago, it hit as high as 31 recently. Why is that important? Well, if you were to purchase a call on the S&P 500 for, let's say it's a $100 call option at the price of 20, and then a month later the VIX is at 30, and you bought that same call option, you would need almost 50% more dollars to buy the same purchasing contract for if the VIX was at 30. And I share that with you is because these vol controls you typically see, they're issued in vol control 5s, vol control 6s, vol control 8s, vol control 10s, and some of them go as high as 16.5. And why is that important? Well, if you take a look at a vol control,
can I ask you to actually just to clarify one thing? When you say vol control 5, 7, 10, because not everybody in our audience may understand that. What you're saying is that is the lower the number, the more strict the vol control is, and the higher end of the number is, the more wide the vol control is. Is that correct? Yeah.
That's a good way of saying it. Mm-hmm. I'd also look at it from this way: the lower the vol control number, the less equity exposure you have. So the lower percentage that's working for you today. So if the market goes up by 1%, the lower amount of your dollars are in equities, and maybe more money's in cash or bonds, if you can look at it that way. So in this white paper here, this kind of shows an example where if you had a S&P 500 risk control 5, which you can actually get those indexes and buy the vol controls on the S&P 500 if you chose to. But the vol 5, and with the VIX being at 20 today, that tells me 5 goes into 20, what percentage? 5 goes into 20 is 25%. So that tells me you have 25% equity exposure with the VIX being 20 today.
And Josh, I don't know if you're looking to have the white paper on the screen. It's not currently on the screen. It's still the vol control indices.
Okay. Let me show the white paper here. Maybe you can see it now.
Yes.
Yep. So essentially what doesn't change is the vol 5 or the vol 6 or vol 8. What does change is the VIX. So just probably about a week ago when the banks were crashing, the VIX was as high as 30. So if you had a volatility control 5 at 100% participation rate, 5 goes into 30, about 17%. So that means you would have 17% equity exposure if you bought that volatility control directly. The reason I share that with you, Mark and Paul, is that a lot of these indexes are giving 200% participation rates. So if the VIX is at 20 like it is today, and you have a volatility control 5, which only has a 25% equity exposure, your participation rate at 200% is really 50% equity exposure. So all that means is if the S&P 500 goes up by 1%, your equity exposure for that day was invested went up by 0.5%, 50% of that. Does that make sense?
It does. In a sense, it's a way of looking at it where 100% isn't always 100% relative to the other variable factors that go into it. And I guess one analogy to look at it from a different perspective is like on an income rider, right? You have roll-up rates and you've got payout factors. Just because you might have a higher roll-up rate does not necessarily mean the income is going to be higher. It also depends on what that payout factor is to get to that net number. So you need to look at a couple different points of reference to really understand like what your opportunity is in terms of getting a credit, correct?
Exactly. So if we take another example here, if you had a risk control 10 on the index that you choose, and 10 goes into 20 is 50%, well, in that example here, if you had a 200% participation rate and you had a risk control 10 and the VIX is at 20 today, you would actually have 100% equity exposure. So if the S&P, as an example, went up by 1%, you would also go up by 1%. If the VIX ever dropped down to 12, like it did in 2018, and you had a risk control 10 at a 200% participation rate, your index would go up by 1%. You'd grow by 166% for that day. So what's great about this is the higher the risk control, think of it, the more equity exposure potential you have. And if you have a lower risk control number, such as risk control 5 or 6, then you need a much higher participation rate to have the same equity exposure. So if you look at the chart below here, if you want to have a 100% participation rate of the equity of the S&P 500 day and you have a Vol 5, you need a 400% participation rate on that Vol 5 to have it. The market goes up by 1, you make 1%.
Yeah.
But if you had a Vol Control 10, then if the market went up by 1%, you'd only need a 200% participation rate on a Vol Control 10.
Yeah, I like, Josh, how this connects the dots. You know, I think too often people look at the products we offer and you look at, to Mark's point, you look at roll-up rates or you look at participation rates. Volatility controls have added sort of another element. And I think it's tough to sometimes put those together. Now you spent a lot of time, as Mark said, connecting with 14 million households. Where are their heads right now? Now, bonds went down last year, as did equity. We know it's like, I think, the third time in the last 100 years where that happened. But if I open up my 401k and I saw that my account went down 20%, this is interesting, right? Simple math. Gosh, how much does my account have to grow to get back to where I was? Oh, 25%. Is volatility, are volatility controls now something that consumers are going to be looking to say, how do we get as less as possible? Less is better in this environment. Or are they going to say, please, in this whole crazy marketplace, take some of this risk off the table?
Yeah, there's a lot of the consumer right now is scared. They took a big hit. Those people that were prudent and diversified, they took a big hit in their bond funds. Interest rates went up, bonds went down, their stock funds went down, and inflation's going up. So what's helped them keep up with inflation a little bit is their houses prices for last year. The house prices went up. This year, housing is expected to go down. And we don't know what the market's going to do. It's kind of stuck in the muck and very volatile. So they're concerned because they feel inflation or shrinkflation. Things are getting much more expensive. But they don't want to lose their money. So they're seeing losses as inflation going up. And they don't know who to trust. And if you look at the banks, a lot of people are pulling their money out of the banks. What's nice to say is not one insurance company with a fixed annuity or indexed annuity has ever lost principal. That's what even when insurance companies went under, no one's ever lost a dime. Policyholders always got their money out. So right now, people are trying to try to protect their assets. And how do you do that? And how do you fight inflation safely? And even though MIGA rates are really great, they're 5%, that's not keeping up with inflation after taxes.
So I think, one really important thing in terms of kind of the innovation behind this, and we've talked about this on previous shows, and I know Paul and Ramsey have talked about it too, is that people tend to kind of follow waves, right? So when the income riders first came out, you saw huge utilization, 80, 90% utilization. And that timing made sense because it was after the 2007, 2008, going to 2009 when those really, became popular, and people were scared. And they're making decisions in terms of, their long-term protection based on that. And then the market started doing really well. And then you saw people dialing back in terms of the utilization, about thinking, hey, this is great. Do I need to spend the money for a rider fee when I can make, more on my credit rates and do systematic withdrawals? And then you get a little shakeup of the market and you start to see these trends shift. And I think, looking at that analogy on the income riders, I think the same holds true on these crediting strategies. Back when interest rates were low, these came out optically, those par rates were much higher. And you saw people really move towards that. And now you're seeing a move back. I think the key here is that there's not one that's good or bad. It's really diversification in different market environments. And it's having a portfolio that allows really the benefit of picking and choosing different opportunities in different market environments, because it's not like you're making a selection today that's really only going to impact based on today's market. These are long-term programs for people's retirement. And I think the more options, the better. And obviously what you're doing to educate, hey, I'm not saying one's right, one's wrong, but here's how you got to look at the differential to balance it out and figure out which ones make sense for which part of your portfolio.
Mark, this is why more than ever it makes sense for advisors to become fiduciaries and understand what indexes are the best ones to choose from. And I think it's critical knowing how to pick which indexes are across the board. I'll kind of walk you through a cool calculator we made, if you can see the screen. Basically, how do you know which vol control number is right for you? Different companies are going to have different numbers. They can have a 5 or 6 or an 8 or 10. They go as high as 16.5. But if you put in the risk control number, 90% of the risk control vols are 5s. You can just, typically it says vol 5 right next to it, or on the index you choose. And then you can look up what the VIX is by clicking this link. It's 21.6 today, so I'll just type in 21.6. And then what is the participation rate you're getting? So some of these companies are paying 200, 300% participation rate. I'll just put 200% in there. And what this shows is it shows what your approximate equity exposure today, or participation rate on a vol 5, with the VIX being at 21. Well, today it would be at 23.15, but because you're getting a 200% participation rate, your equity exposure is closer to 46.3. But if you wanted 100% equity exposure, you would need to have a 431% participation rate. So if the S&P went up by 1%, you would also gain 1% today. And so I share that with you because this kind of compares what you would need if you had a risk control 10. What would your estimated equity exposure be, or participation rate, which would be 46%? And if you wanted 100% equity exposure on a risk control 10, what would you need? And if you had a risk control 16.5, and there's a couple carriers that have higher risk controls like 10 or 16.5, then you would have 76% equity exposure on a risk control 16.5. But if you had a 200% participation rate, you'd be much higher than that. It'd be closer to 150% participation rate. So this just kind of points out that when you choose indexes and vol controls, make sure if you have a low risk control, make sure it has a very high participation rate, or it's okay to have a much lower participation rate if you have a higher vol control. The reason this is important, Mark and Paul, is I don't think financial advisors and consumers really understand how much their money is growing today or what's going to make over the year. How do you calculate that? It's easy to calculate if you have a 50% participation rate in the S&P 500, market goes up by 20, you make 10. That's easy. But it's not easy to see behind the scenes if the market goes way up, how much of that gain did you make when the market rips?
Yeah, and obviously I think there's other factors too in terms of like the volatility itself and how quickly that moves, what type of environment you're in during, either a crediting period or a longer duration. And that's why it's important to obviously, number one, have the choices, right? And then number two, to be able to monitor it, as you go, looking at each term when it comes up for maturity and saying, okay, well, let's maybe adjust based on where we either think the market's going or experiences that we've had based on, the allocations that were made prior to. So
I'm curious, if Ramsey's presenting this to me, Josh, when does he optimize for higher exposure and when does he optimize for lower? What's if I'm the client, what would dictate going up or down?
Well, I think most advisors, most clients just say, oh, wow, I get 300% of the gains of that index. And they're like, that's pretty good. How's that possible? That's what they think. It sounds too good to be true. And a 300% participation rate or 400% participation rate is not too good to be true, because the vol control is very low. It's in a way it's marking things up to mark things down, call to sell. So how do you know how much money is working for you in the market? In a way, that's kind of how I try to simplify it. And it's really simple. You can see the fixed bucket at 4 or 5%, or you can see the S&P 500 at 50% participation rate. You can measure that. But how do you measure how much money is really going up for you? And I think you have to look at what the VIX is at for the day or for the average for the year, and you got to look at your participation rate with the vol number. You have to have all three calculations to be able to say how much do I have a shot of making 20% if the market really goes up. And if you have a very high volatility control, like a 16.5, you really do have a good shot of making double digits. But if you have a very low vol control and the VIX is high average for the year, then I think there's going to be disappointment when the market rips by 20% and clients' statements come in at 5 and 6. But here again, if you look back in 2018, there was times where the VIX was only around 12, and this risk control 5s did really, really well. So I just think we're going to have elevated volatility ever since the pandemic, and it's going to be like that for the next couple of years with all the things going on with inflation.
Rams, you're on mute.
Got me now?
Yep.
Sorry about that. I was saying.
Yep, we can hear you.
Look, there's a lot of really good and important science behind these volatility controlled indices, and to your point, Josh, essentially what dealers and asset managers do with these is they translate what would have been a participation rate or what would have been a cap. They translated that into an asset allocation policy between a risky asset, i.e. equities, and a less risky asset, bonds, right? And for a vol control 5, the relationship is going to be a lot more bonds, relatively speaking, than stocks. And for a risk control 16, it's going to be the other way around. And so, when it ends up being presented to the end consumer and they're told they get, a multiple percentage, like 300% of the vol control index, where really what's happening is, to your point, that can be done because the underlying index is less risky because less of the assets are allocated into the risky asset. So, I think that, having a tool that helps helps both advisors and their clients understand directionally what these things mean is, I think is super important, because the underlying engineering, if you will, is really it's fairly complicated. But I think if people have that top line from 1,000-foot understanding of what it means to have low vol exposure versus high vol exposure, I think is important, and that gets people a long way to where they need to go to make a good decision.
Yeah, Ramsey, you hit the nail on the head. A lot of agents are looking at the illustrations and they're back testing. And they're back testing hypotheticals, and they're back testing on when volatility is much lower. And so I guess the question would be is if you had a 25% participation rate on the S&P 500, would you go to a client and ask them if are they going to average 8% per year, and tell them they're going to average 8% per year? I think the answer with most advisors would be no. You're not going to average 8% with a 25% participation rate. And I think that a lot of the agents are looking at just the back testing in a bull market when the market went straight up, and when volatility was very low. And that's not really fair to say what's going to happen forecasting, what's going to happen in the future, because volatility is much higher, rates are a lot higher, and the lower vol controls can do very well, but you have to have a 300 or 400% participation rate to really compare to a volatility control 16 and a half or so.
So it's interesting. We have a really interesting dynamic on this podcast here today, because, Josh, you're looking at it from the standpoint of helping educate agents, advisors, consumers in terms of how these all play together. And Ramsey, you developed one of the very first, if not the first ones of these strategies. So I guess a question from your perspective, as Josh talks about the education behind it in terms of how they interplay with each other, has the way these unfolded worked out the way that you anticipated initially when you designed? And then secondly, is the behavior patterns along the lines of what you thought might happen in terms of the way that they've drawn attraction?
Wow. So there's a lot in that question. So, first and foremost, one was this idea that in a low rate environment, you did want to give people different ways to make money. For us, one of the most important things was to be able to take institutionally available investment strategies. So strategies that were only available institutions, that we had developed at my prior firm, and actually being able to deliver them, in an FIA, and using that as, in a vol-controlled context as something to provide another way to get exposure, like diversified exposure beyond just the S&P. So there was that piece of it for sure. I think to say, beyond that, what's been sort of amazing to me is how many of the indices there are now. So the first index was in 2012. It was Trader Vic with an insurance company whose name I won't mention. And it was probably about 3 or 4 years until, a lot of other ones started to come out, and then it just took off. So now I think the interesting challenge is to give consumers and advisors, some of the sort of simpler sort of decoder rings, if you will, to figure out how to make some decisions. Because the reality is, if you line up a bunch of different indices next to each other, as somebody who was in the business, sometimes those indices all feel very different to me, one versus the other but there's some big commonalities that I think people should focus on. So, for example, sort of vol control and the vol control levels, and again, the par rates they translate into, I think are very important for people to understand, so they see it as a choice. It's not magic. It's just math, right? It's math. And so you want to give advisors and customers some good rules of thumb to help them with the math without having to get sort of deep into the science. And I think the tools that help you do that are valuable. Did I answer your question?
Yeah, no, very much so. Appreciate it.
All right, cool.
Yeah, Josh, I think, bottom line, what your tool does is allow advisors to have better conversations with clients and better inform them and set expectations that have a higher likelihood of showing up on a statement. And I don't think we can overestimate this. Mark, we get calls all the time from clients who've forgotten that they put money into a 2-year strategy, and they say, well, why am I seeing a 0 return on year 1? Well, let me remind you how a 2-year strategy works. So I don't think we can underestimate the need to make these conversations as clear as possible in the beginning. So Josh, tell us, what's next. We'll certainly share we share a link to your white paper, Mark. I think that'll pass muster. And I think what's next this year. This is going to be a kind of valuable tool for advisors to use.
Yeah, if you download the white paper, it'll kind of give an example of the history of the VIX. It will show what kind of rates do you need to equal to 100% equity exposure. And there's a calculator link in it that you can plug in. There's going to be so many great innovative indexes and participation rates that come out, and it's great. In competition, the consumer wins, the advisor wins. So I think the important thing is so basic rules of thumb is if the risk control is let it go unless it has a very high participation rate. And then the higher risk control number, like a 10 or 16.5, you can actually have more equity exposure and more gains for the client at a much lower percent participation rate because you just have more money working for you in the market. So I think that advisors and agents are going to start doing their due diligence more than just who's the manager behind the index. They're going to start looking at what is the risk control number and what does that mean for the clients and real returns for the forecasting in the future.
Well, thank you. And Ramsey, any final thoughts or questions here?
No, I just want to reiterate what I said. I think rules of thumb are very important in finance because finance, generally speaking, whether at an institutional level and at a personal level, is a natural tension between a great deal of precision on one side, and on the other side, some really important rules of thumb. And in fact, my experience is that much of the finance world really relies on rules of thumb from day to day. So many of them are very important. That's probably for another podcast to go into some of those, but I think it's valuable. Yeah.
That's great. Mark, you want to close for us?
Yeah, I agree with Ramsey's comments about kind of setting a baseline rules of thumb. And, what's interesting is, the the product lines have changed so much over the years. And the one constant that we continuously hear out there is there's complexity in these products and there's a need for education. And I think that that's not going to go away. And I think the more that we can set understandings out there and reach the masses through, pathways that Josh does very well, I think the more education, the better. So I think this is a great way to kind of help, bring that pathway to not having them be so, complex and misunderstood. So I think this is great.
Excellent. All right. Hey, Josh, thanks for, coming back and catching us up on what you're doing. Mark, Ramsey, thanks. And thanks to our listeners. Give us feedback, send us comments, and otherwise, tune in next week for another episode of That Annuity Show. Thanks.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.